started speaking, and now it is 6.36. So clearly at the moment there is no angst about whether they are behind the curve or anything like that. The curve is simply telling us that those who had short positions have now covered their short positions and they are going long on bonds. But we will defer to the experts, Amandeep Chopra of UTI Mutual Fund, Abik Barua, the economist from HDFC Bank, Anand Bagri from RBL, Rajiv Anand from Axis Bank, Taimur Beg, DBS, and Mr. C.S. Sethi, the Managing Director of State Bank of India, are all with us. And in a bit, we'll also go to Aditya Narain. I think he's also with us for a stock market analysis. Well, Mr. Sethi, first up, any changes at all, sir, from the announcements? All policy rates are retained as they are. So any takeaway from a banking sector point of view?
Yeah, good morning, Lata. I think it's on the expected lines. I think as a governor has stated, is more in terms of ensuring that the growth momentum continues. The liquidity management, he has stated that it would be a calibrated liquidity management. I think it's on the expected lines. I feel there are no surprises. But it gives great confidence to us that the momentum which we have seen in the last 2 months, particularly in the Q2, will continue to be there.
Okay, so the home loan wars will continue. You think we get below 6.5 given such a dovish policy?
No, it's not about rates as such. I think the ability of the banks to continue to look for lending and also the borrowers not to worry about any liquidity constraints is the major takeaway from this policy, I feel.
Well, sir, I'll tell you why I was harping about home loans. It was because if he had hinted that the reverse repo will be brought up by whatever, 15 basis points or 20 basis points, there were bankers who said that means at least the rate war ends. A further fall in home loan rates will not be there because that's where the war is. Anyway, he's not announced that, so I assume we cannot rule out a 6.45 on home loan rates. Okay, that's for the large mass of consumers. That's the biggest rate. Now let me get to the economists. Taimur Beg, you think he's behind the curve on inflation forecasts?
I think on the issue of inflation, there's not that much to worry about. Yes, we have high commodity prices around the world. Yes, we have had issues related to supply side disruption. But if you think about the years 2020, 21, and 22, every successive year would be lower inflation. We are going from 6 to 5-ish to 4-ish into 22, 23. So that sort of trajectory that is evident from a forecasting horizon, from global demand perspective, from the perspective of supply side easing eventually, I don't think the central bank needs to worry too much about inflation. And therefore, to your point that are they behind the curve or not, they don't need to be that responsive to begin with because the inflation battle.
Fair point. I mean, even if they have guessed it wrong and the fourth quarter inflation turns out to be, 6 rather than 5.7, it doesn't really move the needle much. I take your point on that. Amandeep Chopra, I didn't understand what he meant by after Jan 22, the variable rate reverse repo will be the main way in which we will absorb liquidity. Does it mean, now they've increased the VRRs will absorb 6.5 lakh crore on 17 December, 7.5 lakh crore on 31st December. What after that? Any guesses? Does he mean that there will be daily variable rate reverse repo?
So, Lata, I guess in terms of the pattern, RBI clearly is following, the set path of reducing liquidity in the system. So, this gradual increase is more or less, very similarly in line with what they did in the previous policy. So, if you look at 7.5 trillion rupees being withdrawn through the, variable reverse repo, it's sort of pretty much close to where the excess liquidity in the system lies. I mean, the range is between 8.5 to 9 odd trillion rupees. So I guess to that extent, he has already outlined the intent to at least reduce, a significant part of that. Going ahead, I guess, depending on how the liquidity situation really prevails in terms of excess liquidity in the system, he could alter it. He could actually increase it if required, or he could actually reduce it. On the other side, whether it can be a daily variable reverse repo rate, I guess, it will be a bit of discordant with having a dual, overnight rates. On one hand, you have the 3.35, reverse repo rate. And on the other side, through VRRR, you're actually bringing it closer to 4%. So I suppose, unless you really bring up the overnight rates much closer to where the VRRR cutoffs are currently taking place, it'll be difficult for them to really manage a daily VRRR.
Okay. Yeah, that was what I agree with you that the excess liquidity, 7.5 lakh crore, is almost entirely getting absorbed by December 31st in the VRRR. But banks still have mutual fund clients who don't want their money to be put into a 14-day lock-in. They want the option of, taking out that money every day. So bankers definitely want a fixed rate daily overnight window, which whatever, if it gives more, so much the better for them. So I mean, I'm still wondering how the fixed rate repo will work, reverse repo will work after Jan 1st. I think the bankers will be better placed. So let me get to Abik and Anand on that. Abik Barua, your thoughts both in terms of bank treasury and more important as an economist. Key takeaways.
No, as an economist, I would tend to agree with you that some of the inflation forecasts are somewhat significantly below what the consensus is, and we kind of go with the consensus. And on the issue of inflation management and the communication, one didn't expect the stance to change, but some communication or some indication of a sort of a rate shift. I think it's sort of kind of out of sync with the change in global central bank narrative, where the notion of transience of inflation and hence the ability to look through has been kind of jettisoned. The Fed is talking about accelerated normalization, taper, and so forth. So this was kind of, I thought a little out of sync with that. I thought inflation, both in terms of the forecasts and the corrective action, at least the sensitization to corrective action wasn't enough. But I think clearly this was a formal acknowledgement that the real monetary policy tool has nothing to do with what the NPC does. It's really what's happening with liquidity management, and by sort of pushing more and more overnight available liquidity of the banks to the VRRR and committing to do more of that, you have and being sort of price taker on the money market side. The RBI has effectively pushed the short end rates up quite considerably, and were credit to pick up going forward, it is going to translate into things like CP rates and short-term lending rates. So I think we shouldn't sort of necessarily say that the RBI is completely insensitive to inflation. It's just that on certain things, it seems to be behind the curve. But if you look at the way it's managing things, it's still doing quite a bit.
There's one market comment that's coming in. No commitment on how much will be on the overnight reverse repo. So probably that 2 lakh crore limit and all will go. It's possible that call rate could go to 4% if the variable rate reverse repo takes away 7.5 lakh crore. Maybe call rate will go to 4% and reverse repo, fixed rate reverse repo could become irrelevant. This is one reading from the market. We will have to see. But before I come with that to Rajiv Anand, just a word on Paytm share. Yeah. The fact that there is going to be a discussion paper on bringing down digital charges or payments, charges on digital payments. It's a discussion paper. The RBI has not said anything. But the Paytm stock has sold off because obviously whatever little money they make on payments is likely to be impacted if the Reserve Bank puts its weight behind reducing charges even further for those who facilitate payments. So just keeping that. Otherwise, the impact of this policy is extremely positive on stock market and bond market. Bond market, we told you the rally from 6.39 to 6.36 on the 10-year. That's something like a 30 paise rise in the bond prices. The Nifty as well went up to 1.3%. It was at the highest point of the day as soon as the speech got over. So that's just by way of reaction. Rajiv Anand, your take. Do you think the call rate will move up because so much more is being absorbed by the variable rate reverse repo from Jan 22 onwards?
So I think clearly the tool that the RBI is using from a process of normalization is VRR and liquidity management, and I think we've got to be clear that this is a process of normalization and tightening. Remember that the repo rate was at 5.15%, pre-COVID. So we've got some way to go as far as that's concerned. And already what we have seen is that the short end has repriced higher, thanks to VRR, etc. And I think that process will continue. But we are going to continue to be in an environment where liquidity will be, today it's about 11 lakh crores. Our estimates is that we will be somewhere between 6 to 8 lakh crores over the next 18 to 24 months. And so therefore, the challenge in front of RBI is really to ensure that the short end rates don't move towards the reverse repo rate, but rather, stay close to the repo rate, and at some point in time in FY23, we start to move the repo rate up, albeit slowly. But I think at this point in time, I think clearly very dovish, and I think the focus is really around growth and growth impulses. And remember, just to the point that you're making about rate wars, remember that, Lata, at this time, credit growth still continues to be, despite rates being where they are, credit growth still continues to be anemic at 7% or thereabouts, although it has moved up from the 5-ish to 7-ish over the last few months. I think the intent really should be to ensure that we get durable growth, and on the back of that, we start to see credit growth going forward. And I think that's perhaps the intent of the RBI as well as we get into FY23.
Mr. Anand, just your quick comments on this discussion paper as well that RBI has proposed on making digital transactions more affordable. We're seeing the likes of Paytm, getting impacted by this already. The intent is clear, although it is still a discussion paper. How will this make life different for banks and for payment companies? What is your initial reading of this?
I'm actually a bit surprised because transactions to the customer are pretty much free. All digital transactions are free to the customer. If there is any charge, it is really being borne by the merchant. So we will have to see that discussion paper to figure out what is the direction that RBI is taking on this.
But will it be advantage banks over payment players? Do you read it like that?
I think so.
Okay. Well, I don't know about the advantage of banks. Aren't you all investing a lot of money because of this? It's an expense on the one hand as well. Anand Bagri, any thoughts? I mean, your market is actually risen. The bond prices have risen. Key takeaways for you?
So very clearly, I think the growth in inflation dynamics took a temporary backseat in this policy, and maybe because of the health concern, because of the COVID concerns. But I believe that RBI is slowly and gradually moving towards normalcy. What we saw on the MSF dispensation also, plus the way RBI has been hiking the VRRs, I think liquidity, they would be absorbing the excess liquidity which is there in the market. We'll also have to see January onwards how the FPI inflow pans out, and how if the bonds were to be included in global indices, how the inflows would be, and if RBI were to absorb excess liquidity after that, what would be the mechanism? Would they be looking at something, some sort of MSF bonds or cash management bills? We'll have to see all that perhaps in the next quarter. As of now, I think slowly and gradually overnight rates would move closer to the risk-free rate would be closer to the repo rate as we see. And the move is in the right direction.
Okay, I don't know if today there has been any impact on the call rate. Okay, call money today is at 3.5. I mean, I don't know if that's an impact already being shown, that eventually there is going to be, more and more money pulled out of the fixed rate. Well, I don't see any much change at the moment in the call money rate. It was higher than what it was yesterday, but otherwise don't see much. Let me see if there is any change in the call money rate. No, nothing much at the moment.
Well, in the meantime, Mr. Taimur Beg, what is your sense now? The reverse repo liftoff that some in the market at least were expecting to happen in December, will it be pushed to February? Will it be pushed further if there is no clarity on the impact of this new variant, or perhaps there are other concerns that emerge later? Mr. Taimur Beg?
Taimur, are you on mute? We are not able to hear you. Okay, we'll reconnect. I can't hear. But I wanted Aditya's views as well. Aditya, the stock market was already in celebratory mood. And after the policy, maybe there was a minor sigh of relief that anyway, not even a timetable for the reverse repo hike has been given. It's an extremely dovish policy. Your thoughts on market's view of the policy and the Paytm view?
So from a market's perspective, as you said, a very dovish policy is all and more that the markets can really hope for. So I think that has fundamentally come through. I think also the fact that the policy continues to prioritize growth, it kind of downplays inflation. And, there's no talk about the path to either tightening or rates increasing. I think all of that is fundamentally very, very comfortable for the markets. I would also say, actually, this is supplementing what Abhi had said, that at some level, there is a slight dissonance between what you're seeing with global policy, where there is, a slightly closer look at the possibilities of tightening, and here where it's been left as a very open field. So I think that dichotomy to some extent augurs well for the domestic market on a relative basis. It can be obviously a challenge that at a later point the RBI needs to adjust a lot faster. But as things stand, if you were to see this policy in isolation, very comfortable for the markets. They couldn't have effectively asked for more.
Oh, absolutely.
In terms of your on the Paytm issue, I think we have to look at where the discussion heads, quite honestly, because I think that it's fairly grey at this point in time what is being talked about. But clearly, I think if UPI is expanded, it is a little bit of a negative for them. But I still think that there just isn't enough clarity on this issue.
No, I'll read out the sentence to you. I'll read out the sentence
to make a call.
I'll read out the sentence to you. Significant increase in acceptance of infrastructure for digital payments has been achieved. Entities involved in providing digital payment services incur costs which are generally recovered from the merchant or the customer, or is borne by one or more of the participants. While there are both advantages and disadvantages of customers bearing these charges, they should be reasonable and should not become a deterrent to the adoption of digital payments. To make a comprehensive view of all this, there is a discussion paper proposed. So, I mean, does it mean that merchants should be, should be made to pay less? In which case, the payment company will have to pay. So, is the interpretation that Paytm, whatever little it's charging merchants, also it will have to bring it down, and therefore will their processing charges increase? That's the only interpretation I can make.
On the face of it, on the face of it, it is a challenge for any intermediary. The language of what is going to be debated. But how that plays out, whether they're actually making any money or enough money, I think that is also a matter up for debate. So a little early to prejudge, but to some extent for stocks like that, it could be a little bit of an overhang.
Yeah. Okay. RBI says this covers all credit cards, debit cards, prepaid payment instruments, and it will also seek feedback on issues including convenience-free surcharging fee, etc., to make digital transactions more affordable. So I think all aspects of these digital transactions are proposed to be covered in this in this discussion paper. So
actually, they should even make a law against banks charging you so much when you buy dollars. I mean, at the moment, nobody is traveling abroad, but some law on that will clearly help a lot of.
Mr. Rajiv Anand, any further clarity? After reading out what the RBI has said on the charges for payment systems.
We'll have to, we'll have to look at the, sort of discussion paper. But I think the only point that I want to make here is that for digital payments, either the merchant has to pay or the consumer has to pay, because there is a service that is being provided, there is a convenience that is being provided, and somebody needs to pay. Various countries across the world have chosen one or the other. In most countries, the merchant pays. In some countries, the consumer pays. But I think all I want to leave, on this conversation is that between merchant and consumer, somebody needs to pay for digital transactions.
Absolutely. Rajiv Anand, you're quite right. In this zest to make it cheap, if the merchants are told to pay less, or the payment provider is asked to pay, actually digitalization may decrease. This is what has happened with RuPay. RuPay cards, the merchants are not allowed to charge anything. So actually RuPay cards are now growing less. It's a disservice if you actually remove the payment, because the number of merchants who are willing to now take RuPay cards falls. So this idea of providing this service free would be a disservice, and I would assume the Reserve Bank knows about it. If anything, they have to allow the merchants to charge on RuPay. Otherwise, it's extremely unfair to that card, which is functioning as well as any other credit card, actually. I hope Taimur is back with us. Taimur, you know, to you and Abik and Amandeep, this is the charge that a critic would make on the Reserve Bank. Their forecasts of inflation are way below what the market's forecasts are. So like in the third quarter, they are in danger of having to come back after the fourth quarter and raise the forecasts. Secondly, no timetable at all in terms of increasing the reverse repo. I mean, we are not in March 2020. The economy is not 70% dysfunctional. It is functioning, of course, with restrictions. At such a time, to keep the reverse repo at 3.35 and not give a timetable, as well, clearly forecasting inflation below what the broad market is. Can these be criticisms of the policy?
Under normal circumstances, Lata, but these are not normal circumstances. We are talking about an economy that had a massive contraction just a few quarters ago, not like years ago. So the scarring, the depth of damage, especially between the India and the Bharat economy, the bifurcation in the economy between the formal and the informal sector is so much that right now to start talking about the year-on-year growth numbers being a motivation to start normalizing policy, in my view, is playing with fire. There's tremendous amount of uncertainty, not just at the inflation end. Inflation, as you can see, oil can go from $85 to $70 just like that. Baltic dry freight can go from thousands of dollars to hundreds of dollars just like that. So we're still dealing with a global economy on the edge. Secondly, on the issue of financial stability, are we seeing excessive credit growth? I heard you talk earlier about competition between companies in terms of mortgage rates and so on. But when we look at real credit growth in India, compared to normal times, we still have a long ways to go. When we look at the output gap, we have a long ways to go. When we look at the impact of external capital flow coming into India, that was a major concern, which is why the RBI has intervened so heavily over the last year and built up such a huge reserve chest. But 2022, most likely the opposite story for emerging markets. Capital will flow out as the Fed hikes, exchanges will come under pressure. Those are not necessarily the time when you want to fight the Fed by keeping rates too low, and therefore the liquidity absorption is being taking place. We are going to see some degree of market-driven rates go up, but outright repo rate hike to slow the economy down at a time when the output gap is substantial, and through that expect inflation to come down when it is coming down anyway, I don't see the point.
Just we have to conclude this conversation, but I take your point. The RBI has to worry about an economy that is just the size it was 2 years ago, or even less in some sectors, and it has to be more supportive. In any case, it's not that inflation is going above 6%, so why need they worry? It's just perhaps correcting anomalies that the market was expecting. And then there can be a perfect storm. There can be a Fed that is aggressively buying up bonds or reducing taper. There can be a jump in crude prices, and trade deficit, mind you, in the last 3 months has been ticking at $20 billion and above. Our services inflows are 10 billion. So you can be racing towards 100 to 120 billion current account deficit in the next 12 months, and you could enter a perfect storm and Reserve Bank will have to move up in a hurry. But all these are only scenarios, and at the moment the scenario is benign. The space is available for growth to be given a shoulder, a leg and an arm, and therefore that's exactly what the RBI has done. We wind up this discussion. Aditya, Amandeep, Abik, Taimur, Rajiv Anand Bagri, all of you, thank you very much for enriching our understanding of the policy. We turn round now to Mukesh Ambani, the chairman of Reliance Industries, who is speaking at the India Mobile Congress.